All right, still business edge now for the first conversation. Dangote Sugar reported its highest ever quarterly revenue of 213.93 billion naira in Q1 2025, and this is marking a 32%. This is 32% of its full year 2024 total. The stock rose 16.3% year to date, but upside remains cautious without consistent profitability. Could this be a sign of recovery for Nigeria's FMCG sectors? Are they recovering from what happened in 2024, the lows of 2024? Let's find out as we speak with Kayode Eseyin, Cardinal Investment Associates. He joins me now, and it's great to have you in.
Yeah, thank you. Thank you very much for having me.
Yes, it's a pleasure. So we're going to begin with Dangote Sugar, right, and then perhaps go to the wider sector. Dangote Sugar has recorded its highest ever quarterly revenue, recording 213.93 billion naira in Q1 alone, 2025. That's already 32% of what it made full year 2024. So what's the driver here?
Thank you for that question. Looking at the consumer goods sector and by extension, that sugar as a whole, what we've seen, interestingly, across say a 6 month or even 9 month period was essentially a recovery in sentiment. First of all, what has happened majorly is that we have seen a more stable FX environment, and as we know, FX is a major contributor of inflation dynamic in Nigeria, and so the relative stability we've seen over the past 3 to 6 month period has meant that expectation for inflation and even inflation in itself are starting to moderate. Before the rebasing of the CPI, what we saw was a general trend downwards in inflation, and even post rebasing, inflation seemed to be on the decline, save for the last month's numbers that we saw. And so what that means is that consumer wallets are starting to pick up, and this has been very, very clear, especially speaking with FMCG manufacturers themselves. They confirmed that recovery in volumes have been significantly even well ahead of what they anticipated themselves. Particularly, the market consensus was that the recovery would essentially, there would be a recovery, obviously, because we were not expected to be going through the pressures forever, but the recovery came in faster than we saw. And so that means that both on the pricing front, particularly on the volume front, we have seen support for FMCGs across board. It's even more interesting for Dangote Sugar because if you check across the review period, that's for the Q1 25, we saw price adjustments across their products. And so for them, what that means is that in terms of pricing, they were able to benefit from the fact that they are able to pass on a large chunk of these cost pressures to their consumers, customers rather.
I was going to get to that.
And then also the volume recovery just made sure that the revenue growth was really, really, really strong.
So I was going to get to that. You mentioned that part of it is due to increase in volume, but there are those who are saying that it's not necessarily that these FMCGs or consumer goods are selling more, but they have doubled their prices. They've handed the problems, right, macroeconomic problems, down to the consumer. Consumers are paying double, and that is what is reflecting on their books. Is that the case?
So it's like I tried to explain, it's a combination of both. Yeah. So I mean, when the cost pressures really became a major problem for them last year, they had two options. One was either to pass all of these costs to consumer or accept some of these cost pressures in terms of margins. And I think they ended up doing both. Quite a number of, particularly Dangote, even reported margin decline. But in places where they pass on some of these costs to consumers, and that led to an initial pullback in volumes, right? But going into late 2024 and early this year, what I'm saying now is that though pricing still plays a major role in the revenue growth we are seeing, because prices are still elevated compared to last year, significantly elevated, as a matter of fact, like you said, close to 100%, but volumes are starting to pick up. So it's not all pricing that we are seeing contributing to revenue growth in the first quarter of the year for Dangote and other consumer goods names.
Okay, so perhaps purchasing power of consumers is strengthening. But we see that despite the strong top line, profitability also remains under pressure, a pre-tax loss of 22.63 billion. What's the drawback here?
So for Dangote Sugar particularly, I think they play in a very interesting sector. That sugar is also a very important, essential commodity used across both industrial, household, and even pharmaceutical usages. But recently, what we have seen is that there are quite a number of new kids on the block. The industry is not as monopolistic, and I use that term loosely, as it was before. And so what that means is there's a limit to which prices can be raised aggressively. Of course, they tried as much as possible to raise prices to cover some of the cost pressures that they felt, but because of the structure and dynamic of the market, there was a limit to which they could raise prices. And so what that means is that the company also still had to accept some of these cost pressures in terms of profitability cuts on its own books, and that's the major drag. And so, and currently, even though FX volatility is starting to wane, the fact that current exchange rate still remains significantly higher than what it was last year means that, again, for a company like Dan Sugar that imports almost all of its raw materials in terms of raw sugar, which it refines, they are still very much exposed to these cost pressures, and the inability to pass on all of these costs to consumers means that profitability would likely be hampered, at least in the midterm. There have been talks about the backward integration plan, but those talks have been on for quite a long time now. I know there's been progress on that front. As it is now, the government still has to import a large portion of its raw sugar. And when you will add the exchange rate and then logistic costs, it's now very clear why some of these sugar manufacturers would likely.
All right, we'll get into that, more after this break. It's still Business Edge, and we are talking the turnaround for FMCGs. Stay with us. All right, still Business Edge. Kayode Eseyin still with us. Kayode, before the break, you were talking about the backward integration program that Dangote Sugar had adopted to mitigate some of its losses. Pick up from there, but also touch on perhaps, we know that Dangote Sugar has also expanded their asset base over the past 1 year. Growth in that regard has stabilized on a quarterly basis. Do you see them perhaps sweating out those assets in the near future? What impact will this have on their books?
I think the decision to expand asset base is a strategic one, and of course, as you'd expect, for any businessman, the intention really is to get as much value as you can from your assets, especially to shareholders. But like I said earlier, so what we expect is that on the revenue front, we expect this current trend to continue. The company will likely boost significant returns in terms of revenue, top line growth rather, in the current year. But as long as these cost pressures remain, unless the company is able to significantly mitigate some of its cost pressures, raw materials, sugar prices, exchange rates. So interestingly, we are starting to see some moderation in sugar prices, particularly due to Donald Trump's tariffs and the impact on the global economy at large. But it remains to be seen whether those moderation in prices will be enough to return the company to profitability. So going forward, the company will definitely sweat its assets as much as it could. But those cost pressures will continue to remain a challenge, depending on whether or not they are able to. And I think that might be key to unlocking value or return to profitability in the current year, from how far they can push or stretch those price increases that I mentioned earlier. It just remains to be seen whether they will be able to return to profitability. But on the cost side of things, it's looking really, really gloomy.
Sounds like a lot of unpredictable, factors there that could influence things with that company. But finally, with Dangote Sugar, the share price closed at about 36 naira, 65 kobo, a 16.3% year-to-date gain. We really haven't seen a significant jump in share price since early last year. Do you expect it to return or remain on that trajectory, especially if you consider the wider sectoral performance?
Oh, okay, so there's two ways to look at it. Yeah, I mean, there's this saying I like when particularly talking about consumers, and it's that a rising tide lifts all boats, and that may be true, or may explain the reason why we are seeing the uptick in prices for Dan Sugar. Yet today, the consumer goods sector is one of the best performing sectors in the NGX and that may be partly due to the fact that the general consensus of return to profitability among consumer goods players is starting to really play out. We saw fantastic results across board. But for Dan Sugar in particular, we think that the profitability issues will remain a key drag. And compared to its peers, Dan Sugar's returns on a year-to-date basis lag significantly among quite a number of other players. And that just goes to show that the market is still waiting for a sense of direction from the company, particularly on how they intend to mitigate these challenges that they are facing. So I think that the answer to that question will remain key to whether or not we would see real value returns to shareholders in in the current year.
All right, so for FMCGs as a whole, consumer goods, can we say that the worst is behind them? Is it a more stable outlook ahead for 2025?
Yes, okay. The short answer to that is yes, particularly due to the fact that quite a number of them have learned significant lessons from how they handled the Nigerian macroeconomic climate. Particularly, a number of them historically have relied heavily on input raw materials for manufacturing of their goods. And that was essentially what led to the issues they had in the first place. And it happened for two main reasons. Number one, the raw materials themselves being imported and priced in dollars had a significant impact on their margins and profitability because the dollar or the naira value of those raw materials went up significantly. And then also that number of them who had imported significant levels of raw materials had yet to make the payments for some of those goods that they imported, and this led to them having a short open positions, essentially having more dollar liabilities than assets. And so when the currency moved against them, this led to a revaluation of assets, of liabilities rather, leading to FX losses. And so most of them went back to the drawing board and decided to tweak their business model. And quite a number of them had announced that they are making significant progresses to backward integrate their production, essentially hedging against FX risk. And some of them are taking steps to significantly pay down a large portion of their foreign currency liabilities with good results. As a matter of fact, a number of FMCGs currently are net long dollars, and so what that means is they might even benefit from foreign currency evaluation. And all of this just goes to show that going forward, the FMCG as a whole, of course, there are specific differences. It's better positions to mitigate against foreign currency volatility, and that's very clear in their Q1 numbers. Quite a number of them did significantly well.
Yeah, so the short answer is yes, right? The worst is behind them. Finally, let's come to investors. What's their take home? What's the note for investors who are seeking exposure to Nigerian consumer goods? Does all this spell consistent profitability for the sector through the rest of 2025?
Yes, so I would answer your last question first. The answer is that the general expectation is that at least the sector as a whole again will return to profitability. We are quite optimistic on quite a number of names in that space. Nestle, Guinness are the first that comes to mind. NASCO and a Dangote Sugar sister company is also reporting fantastic earnings. And so it just goes to show that for the rest of the year, the outlook is positive for the companies as a whole. But yeah, as I'd always say, when investing, it's very important to do your due diligence and speak to seasoned professionals to help you decide and shift through the entire stock market and vis-a-vis your investment considerations to give you investment advice. But yeah, as a whole, the investors are quite, it would be quite wise to position in the FMCG sector this year at least and ride the rally of the expected return to profitability.
All right, Kayode Eseyin, Cardinal Investment Associates. Thank you for joining me.
Yeah, you're welcome.